Joining us right now to talk more about this market meltdown recently and what's happening this morning is Pacer ETS Distributors President Sean O'Hara. Sean, great to see you.
Good to see you.
Well, are you seeing outflows?
No, we're seeing inflows. Most of what we have is trend-following strategies, and as mentioned in the break, a lot of that money is sitting in T-bills, and so people feel fairly comfortable waiting it out to see which direction the market's going to go. If you watch this market, it started there's no contagion on the trend lines, right? So emerging
markets. What do you think is going on?
I think there's a big rotation from growth to value going on. I think that the growth stocks have led for the last 10 years, and value has underperformed. You know, if you look at the disparity between returning growth and value, if you look at the chart, they call it alligator jaws in Wall Street parlance. Eventually, all those alligator jaws eventually slam shut, and it's gone so long now that it either needs to be a really severe change in direction or a long trend the other way towards value.
Is that rotation permanent, though? I mean, there's these big FANG names. Does that mean they're out and everybody's going to focus on value stocks?
I think you'll see a trend towards that. It's, you know, they go in cycles. They tend to kind of go back and forth.
What's Apple? Because it was trading at like 17 times.
When does it become value?
Is that value?
Well, so here's the deal, right? If you've been doing this a long time. You remember Walmart and McDonald's in the 90s. They were great growth names, right? But they grew so big that their growth was challenged just by their size. And in some of these tech names, I think that's sort of what's going on. You can't continue to grow at the rate you've been growing at forever. So what happened with those stocks is they sort of plateaued for a while until their earnings could catch back up.
Yeah, but you're talking about like how Pfizer had like these super high P ratios in the late 90s, or Home Depot. Today, you're not going to magically avoid that alligator jaw you're talking about. Maybe it was crocodile, because the value funds, the ETFs might just as soon have Apple because the P ratio is low enough for the price to book or whatever. Like, to really avoid those growthy stocks. And by the way, they're creeping into everything in the ETF business. They just started putting Facebook and all those into the telecom funds, the ETFs, as you know, because they changed the telecom index. So all of a sudden you've got a tech fund when you had a supposedly widows and orphans utility telecom fund, which would have done well this year if they didn't put Facebook in the funds. Right. So how do you, as an investor, avoid that when the ETFs are making it actually more difficult to do it?
Well, the way we do it is we look at something called free cash flow yield, which leads you away from high valuations and big debt on the balance sheet. So the free cash flow yield is the free cash flow a company generates divided by its enterprise value, and enterprise value is market cap plus debt. So, you know, we missed buying, for example, GE, which would look like a cheap stock, which could continue to go lower because it doesn't screen into our ETFs that are our value suite. So,
let me circle back to you, but you were talking about going to cash and T-bills with some sort of like a 200-day moving average type thing. The last mini crashes, we haven't had a big one really since the almost 20% one after the debt crisis in Europe. They've come back so fast. We just saw it after the elections. Going to cash has put you in cash and then miss a 3-day rebound that takes you back to market highs, and then you got to buy back into stocks, and then does it again. Like, is that a dangerous strategy?
For the investor who uses our strategies, who uses a trend following strategy like that, I think they're willing to accept that they might be a little late getting back in, so long as they're not in the catastrophic declines.
But like that recent slide that came back with the election, remember
did
it go to cash and then you had to go back to stocks?
We were long since February of 2016. So even during that volatility, the 200-day moving average was never pierced. So the reason you use a 200-day moving average as opposed to a 50,
did put you back into cash.
It did.
Okay,
and
so it's more severe than the last one.
It is. And so the reason you use a 200-day versus a 50 or 150 or a 50-day is that you make less changes. And when you make less changes, that's when you avoid some of these really dangerous whipsaws and trailing getting back into the market.
Real quick, would you tell an investor to go to cash and wait for it to come back, or go to value and out of growth?
I think we would say do a little bit of both if you're in your portfolio. It's like next year, you know, one of the topics was supposed to be ETFs for next year. I think large cap U.S. value, I think international and global, and I think protection strategies have to be a part of what's in people's portfolios.
Why do you like those ETFs, though? I mean, are you seeing a recovery for the global economy?
No, not yet.
Will something change, or has something specifically changed with the backdrop in terms of growth?
I think it's more of a contrarian bet. You want to buy what's cheap relative to everything else, right?
So you're just trading on valuation.
If you just look at the U.S. versus international, or growth versus value the last 10 years, it's been disastrous for international and global, and it's been disastrous for value. Those trends can't continue forever. They can continue for a little while longer, but if I'm thinking in the next 3 to 5 years, I'm going to put money to work in this market, and I'm a little bit worried about, you know, the growth names, I would be moving portfolios towards large cap value and international and
just really
global.
Quickly, worth noting that analysts are marking down their profit estimates for companies with the most international exposure much faster than those that are more focused on the United States.
What do you say say to that?
That the former, that the ones with international exposure are expected to rise 9.4% in the fourth quarter, but it's 16.5% for U.S. focused companies. So that's a recent trend.
So do you think that has to do with China? I mean, I'm wondering if it's the emerging markets
or
which is the issue.
Or the strong dollar.
Yeah, it's the strong dollar, which you've talked about for a long time, and also just slowing global growth. In other parts of the the world.
Real quick on global growth, the OECD came out this morning and they've revised downward their forecast for global economic growth, not by a ton, from 3.7 to 3.5.
So this is really interesting. Look what we're hearing here, and you're telling us to go into global stocks.
Well, I think because you want to buy ahead as opposed to behind, right? You don't want to chase returns, but if you're a longer-term investor, what you want to do is you want to position your portfolio for the long term and what's going to happen. And I think these macro trends on value underperforming growth and international and global underperforming U.S. can't continue forever, and sooner or later they'll turn around. And the catalyst, by the way, the bad news in the market, stocks go down before the euphoria is over, right? So they tend to be anticipatory, as markets are as well. So they're looking ahead as well.
I would be more inclined to go with the pendulum shifting strategy, which is more reliable than the global economic forecast by some banks. But I will say, unlike 2000, where there was a real divergence, where it was like a nifty 50, and then like small cap value was down. It wasn't just lagging like the value stocks today. You're not going to get such a reward being diversified. In fact, one of the problems in the market right now is diversification isn't stopping you from losing money on the downside.
And you know what? Why that is because of all the unprecedented monetary stimulus, because it literally lifted every asset class in the last decade.
It's because of all the unprecedented number of ETFs giving people options to have money. Every advisor now is like, I'm not going to do what I did in the 90s and just own PBHG growth funds and Janus, and that was my diversification. They're like, oh, I got a piece of small cap growth, I got small cap value, I got four in this, I got four bonds, and then it all goes down at once. And it doesn't work if everybody does it. So everyone stop doing this so I can make some money again for clients.
But keep things in perspective, Jonas. There's $19 trillion in mutual funds. There's $3 trillion in ETFs in the U.S.
But it's all the hot money.
But it's not really all the hot money. I mean, we're in the ETF business. There is some hot money in ETFs, but it's being adopted.
What's the average holding period of an investor in an ETF?
Well, for us, it's long term. So, and for the bulk of, let's say, people
I would think it is long term.
Who are building portfolios.
You don't think it's long term? You think people are trading ETFs?
Not the ones. Okay, I'm not going to be mad. Like, again, I don't think this stuff should be in the mutual business. But when you look at the holding period of an open-end Vanguard fund versus an ETF, especially one that's a trend or a sector or a smart beta, it is like 1 day to like 10,000 days.
See, I agree on all these specialties and these specific ETFs that are real special. But if you just do an ETF, dividend payers, growth names, you keep
the
those
ones
long
I'm
term.
using, I own because they're the total market index funds you own for years, whatever. But unless you're rebalancing. But when you're talking about these specific ETFs, where you're like, I want to be in.
Well, that's different. That I agree with.
A lot of it's hedge fund money in there. It's hot money. Again, it doesn't mean it's bad. All the hot money is smart money.
This is sort of like the flavor of the moment, is what you're saying.
It's exposure versus investing, right? We deal primarily with financial advisors who are building portfolios for clients over the long haul, and they're simply replacing open-end mutual funds with ETFs as proxies for the long term because they're more tax efficient and they cost less. So, there are some people using ETFs like hedge funds for quick exposures and then getting out, but the bulk of the money I still believe is long term.
Do you want 2 and 20 or do you want basis points?
We're going to find out how long term it is when the bond market crashes. It's all in
2 and 20.
Yeah, exactly. Sean, it's really good to see you.
Thank you so much. Happy Thanksgiving to everybody.
Great to see you. Sean O'Hara joining us.